Materiality is an auditor's preliminary estimates of the smallest amount of misstatement that could be material to the client financial statement. Information is material if the misstatements could influence the economic decisions of users taken on basis of financial statement. It is the criteria used by accountants and auditors in order to differentiate between crucial matters and unimportant matters. The auditor should bring the matters to client attention, to give a true and fair view opinion on financial statement, if the material misstatements exist. Next, concept of materiality. The financial statements may contain misstatements but not so large. Understanding allows auditors to use sampling techniques, therefore could be completed on reasonable cost. Fraud and errors are the sources of misstatements. Material misstatement is the material amount of misstatement and any failure to comply with the Companies Act 2016 requirement. In determining material misstatement, quantitative and qualitative measures should be considered. Relative concept rather than absolute. For example, a misstatement of RM 1 million would be material for a small company but may not for a large company. Bases are needed for evaluating materiality. Net sales and total assets are normally used as primary base. A misstatement of RM 100,000 would be material. The materiality threshold can be expressed on bases selected rather than absolute amount. The quantitative guideline. There is no official guidelines on quantitative measures of materiality. This is the table, in which it states all the bases used in measuring materiality, and also the materiality threshold, which stated in terms of percentage. In terms of qualitative factors, it can also affect materiality. Certain types of misstatements are important even if the dollar amounts are small. For examples, misstatement could be material when there is amount involving fraud considered more important than error and if bad consequences arising from contractual obligations. Moreover, if it affects a trend in earning, then misstatement could be material too, and also the misstatements that are immaterial but still need to disclose to comply disclosure requirement. However, no specific rules is provided in determining materiality. It requires professional judgment by practitioners. For the policy statement, which is materiality guidelines, for an example, professional judgment is to be used at all times in setting and applying guideline. The combined total of misstatement, which exceed 10% is material. But, if it less than 5%, it is immaterial, and if it between 5% and 10%, it requires professional judgment to determine their materiality. The 5% to 10% must be measured in relation to the appropriate base. The recommendations in selecting the appropriate base are in terms of income statement and balance sheet. In income statement, the combined misstatements are measured at 5% to 10% of profit before tax, depends on the size of income. While, in balance sheet, the combined misstatements should originally be measured for current assets and current liabilities, which are 5% and 10%, and for total assets are in between 3% to 6%.